Hey everyone, and welcome back. Today we're jumping right into day 29 of the semi-hierarchy internal auditing series, focusing specifically on fixed assets audits. Getting your fixed assets right is absolutely critical for the financial health and operational efficiency of literally any organization, so let's dive right in.
Let's get our foundational definition out of the way first. What exactly is a fixed asset? Well, according to the material, fixed assets, or FA, are long-term tangible assets held by the organization to use in operations, and importantly, they are not for sale. A fixed assets audit ensures that these assets are accurately recorded, properly safeguarded, and used effectively to support the organization's goals. We're talking about things like factory machinery humming on the production floor, delivery trucks out on the road, or the massive servers powering your IT department. These aren't products sitting on a shelf waiting for a buyer, they're the actual engines of your daily operations.
Here's our roadmap for this explainer. We're going to hit 6 key areas: objectives and key risks, key controls and process, audit procedures and focus, a real-world fixed asset purchase example, red flags and impact, and then wrap it up with our key takeaway and conclusion.
We're going to be using this Day 29 Fixed Assets Audit infographic as our visual guide today. It's a fantastic breakdown, and by the end of this explainer, we'll have worked through every single box in this framework to give you a really granular understanding of how all these pieces fit together.
All right, let's kick things off with Section 1, Objectives and Key Risks. So what are our primary objectives here? Honestly, it's all about validation and accuracy. First up, ensure existence and ownership. If the books say you own a delivery truck, you better be able to walk out to the lot, physically verify it's there, and prove the company holds the title. We also need to ensure completeness. If there are 10 machines on the floor, all 10 need to be in the records. We're verifying accuracy and valuation, ensuring proper classification and capitalization so capital assets aren't accidentally expensed, checking that they're safeguarded for legitimate business use, and of course, confirming total compliance with policies and standards.
Now flip that over to the key risks. What keeps auditors up at night? Unrecorded assets, for starters, or an over- or understatement of value that can completely warp a balance sheet. And then there's unauthorized purchases and disposals. Imagine an employee just selling off a company laptop without telling anyone? Yeah, it happens. Beyond that, the material highlights risks like lost or stolen assets, incorrect depreciation or useful life schedules, and poor maintenance that leads to things breaking down early. Plus, any non-compliance here can severely mess up the financial reporting.
Let's move right into Section 2, Key Controls and Process.
To fight off those risks we just talked about, you've got to have tight controls in place. We're talking strict purchase and disposal authorization paired with really careful vendor selection. You also need routine physical verification and solid asset tagging so everything stays updated in the asset register. Oh, and a huge one here, segregation of duties. The person who approves buying the asset should absolutely never be the one paying the vendor or updating the ledger. Rounding it out, you need timely depreciation, regular impairment reviews, and adequate insurance on all physical assets.
Let's walk through the first 4 steps of the actual fixed assets process. Step 1 is identifying a need. Say your IT department needs a massive new server to handle website traffic. Step 2 is getting formal management approval. Step 3, you execute the purchase with an approved vendor. And Step 4, you receive the asset and make sure it's exactly what you ordered. Then we pick up with Step 5, recording it in the asset register and slapping a physical tag like a barcode on it for tracking. Step 6 is the active phase, using and maintaining the asset throughout its life. Step 7 involves periodic physical verifications to confirm the asset is still there and in good shape. Finally, Step 8 is disposal, where you officially retire it according to company policy when it's obsolete.
Let's translate that theory into fieldwork with Section 3, Audit Procedures and Focus.
So how do auditors actually test this stuff? Well, first, they need to deeply understand the overarching process and review the capitalization policy. Then they'll test additions by checking for authorization and matching documents, like literally comparing an invoice to the asset register. They'll verify existence and tagging, reconcile the register with the general ledger, review the depreciation math for accuracy, and test samples of both disposals and impairment to make sure everything is strictly by the book.
And as they're doing this, there are a few huge areas to focus on. It's not just, hey, is the machine there? It's about confirming true ownership rights, proper capitalization, and accurate, useful life assignments. They're heavily scrutinizing how assets are safeguarded, the actual operational condition of the items, the integrity of the disposal process, and reconciliation. And crucially,
Strict compliance with accounting standards like IND AS 16 or IAS 16 is totally non-negotiable.
Let's make this concrete with Section 4, a fixed asset purchase example. The source gives us a super relatable scenario. Let's say we buy an office laptop. The vendor is Tech Solutions Private Limited, invoice number INV-2548, dated April 5, 2024. The base cost is 65,000 rupees, plus 11,700 in GST. We capitalize it on that same day, April 5th, with a useful life of 3 years using the straight-line depreciation method. Now, notice that total amount? 76,700 rupees. This is a perfect example of how capitalization actually works. You don't just record the 65,000 base cost, you add the 11,700 GST to get your total capitalized amount. That entire sum is what goes on the balance sheet. And from that 76,700 total, we derive our annual depreciation figure of 21,667 rupees. Because we're using the straight line method over a 3-year useful life, you just take that total capitalized cost and slice it into 3 even pieces. It's clean, simple, and exactly what an auditor is looking for. Moving into the home stretch, let's look at Section 5, Red Flags and Impact.
Auditors are basically financial detectives, right? And there are some massive red flags they watch for. We're talking about assets that haven't been physically verified, or tags that haven't been updated. Large unrecorded assets or unauthorized purchases are huge warning signs. Or what about unused assets just lying idle? Imagine walking into a warehouse and finding a wildly expensive machine just gathering dust for a year. That raises serious questions about capital allocation. Throw in incorrect depreciation, unauthorized disposals, or mismatches in the records, and you've got yourself a major problem to investigate.
But why does an effective fixed assets audit matter so much? Well, it ensures accurate reporting and prevents loss or theft, for sure. But it also optimizes how those assets are utilized and ensures strict compliance. Ultimately, this all supports better decision-making and control. Think about it. When executive leadership actually knows what assets they have, what condition they're in, and what they're truly worth, they can make incredibly smart strategic business moves. Which brings us to our final section, the key takeaway and conclusion. Here is the ultimate key takeaway from today's material. A strong fixed assets control environment and regular audits ensure assets are recorded accurately, safeguarded properly, and used efficiently to create value. It's an important reminder that this isn't just about enforcing arbitrary rules. It's about actively protecting and generating real value for the organization. And I want to leave you with this fantastic quote from the source. Well-managed assets today build a stronger organization tomorrow. It really makes you think, doesn't it? If you were to walk around your own company right now, how many ghost assets or idle machines would you find silently dragging down the bottom line? Food for thought. Thanks for tuning into this explainer, and I'll catch you in the next one.